Hello, everyone, and welcome back to another installment of our Lunch and Learn webinar series. I am your host, Mayur Thaker, and I am an analyst as well as a senior relationship manager here at Zacks Professional Services. And I will be speaking today regarding utilizing a strategy to identify potential deep value opportunities in the market today. The big focus over the last year and really over the last 10 years, but especially over the last year, has been these high flying technology stocks. Everyone, throughout financial media, CNBC, Bloomberg, and so many other outlets, the subject of technology companies have dominated the conversation, and that's where the vast majority of the returns have come from. So I'm going to potentially offer up a different approach as to what might be very attractively valued today, as we see technology stocks and so many other companies reach very, very lofty valuations. I'm not saying that they're necessarily overvalued, those companies, but what can we use with the Advisor Tools platform to help identify companies that have an interesting investment opportunity right now based on its valuation today. So as just a housekeeping measure, I'm just going to review this disclosure here, as well as if you do have any questions as we go along in the presentation, you can enter that into the GoToMeeting webinar in the panel, and I will spend the last couple minutes of the call to answer any of those questions. So let's go ahead and get started. So, what is the first step that we can use? And this is the most common thing that, investment managers use, which is looking at price multiples, right? That's what everyone has kind of been trained to do, is to look at the PE multiple. But what I'm trying to focus here is to focus not as much on multiples as you would to intrinsic value, right? And there's a number of tools to help estimate that. And this is something that, Warren Buffett, Charlie Munger have spent their entire careers talking about, and so many of their contemporaries. So the first thing is to, the first approach I would take, even when you're searching for, very deeply, valued or low value opportunities or deep value opportunities, is I wouldn't focus as much on absolute price multiples, like price to earnings, price to free cash flow, EV to EBITDA. I wouldn't, those are useful metrics, but I wouldn't place an excessive focus on those multiples. And they shouldn't be used or viewed in isolation. So definitely you should use them, pay attention to them. But we also have to remember that stocks that trade at very low multiples often do so for some good reason. So that's why these metrics should not be viewed in isolation. And something that's a little bit more useful would be relative price multiple contraction or expansion. So rather than looking at the absolute multiple, like, currently the stock trades at 15 times earnings, and that sounds pretty good. But if it's always traded at 15 times earnings, or relative to the market, it's always been at that level, then, it may not be as deep of a value opportunity as it would seem. Or let's say a company trades at 10 times earnings, and that's really cheap. But what if it traditionally traded at 20 times earnings? What if it traditionally traded at 5 times earnings, or 7 or 8 times earnings? In that case, that's a multiple expansion, not low multiples, So I would place the focus more so on relative price multiple contraction, rather than just the absolute multiple, like a PE of 12 or 15, right? And but the majority of the focus should be on comparing today's market price to intrinsic value. And intrinsic value is based on discounting future earnings. Okay, so we're going to get into that a little bit more. This is a more of a tool that we have in our Zacks research system. That's our other offering that we have, not kind of within the Advisor Tools framework, but there is a valuation model that we have built that allows you to estimate what a company's intrinsic value might be. But I'll show you some of the tools that you can use from that that is available within Advisor Tools. So we'll get to that in a few minutes here. So what we want to do ultimately is when we are picking companies that could be very deep value opportunities, we want to find a large margin of safety. And this is a key concept here. Something that Warren Buffett has talked about ad nauseum over the years. If you've read his letters to shareholders, when they make a purchase of a company, they want to make sure that when they are estimating the intrinsic value of the company that they're buying, they want to see a big disconnect between their estimate of intrinsic value and the current market price. And the reason for that is because that way it gives you a large margin of safety, meaning you could be wrong in your earnings growth forecast, or you could be wrong on interest rates, right? And those are the two things that drive stock valuations in the long run, right? Earnings growth and interest rates, right? As interest rates rise, in general, stock multiples fall, and as growth rates increase, stock multiples rise, right? So what they want to do is they want to find companies that have a very large margin of safety, a big disconnect between the market price today and what the intrinsic value is based on modest growth and interest rate forecasts. And so that way, the idea is that even if you are wrong, because it's obviously next to impossible to know what a company is going to be doing 5 to 10 years out. It's hard enough to predict what the company will do next quarter, let alone 5 to 10 years out. So you could be wrong and still be right directionally in the company's stock price. So that's what we want to do, is find companies that have a large margin of safety. So again, it allows for room for error in our future earnings and interest rate forecasts. So that's the first step. Now, return on invested capital is what we want to focus on the next, set of criteria. So this is the single greatest metric to reveal cheap stocks for a reason. Stocks that are cheap for a reason, right? There are many companies that trade at very low multiples, but also do very, very low returns on capital, meaning single low digit numbers. And so what you want to focus on is are companies that are not just low in multiple, but also high in ROIC. And you're going to see that this step alone separates a lot of companies. It separates, a lot of junk out there from true quality. Okay. So it helps you avoid value traps. It's a very powerful method to do this. And the general calculation is EBIT, right, which is also known as operating income, divided by the net working capital of the company, plus the total long-term assets of the company. So basically, what is this telling you? It's telling you the rate of return that the company generates on its capital base, right? So it's essentially like, thinking of it in terms of the interest rate that you earn on your bank account. Let's say you're shopping around for different savings accounts, and one bank offers you, in today's interest rate world, it's probably something like, at most 0.25%, right? But what if another bank was offering you 0.35% and another was offering you 0.5%? And let's just say, one bank was really optimistic. They were offering you 1%, interest on your savings. So you'd obviously choose the one that has the best interest rate, right? And it would be the 1%. So that is basically what the return on invested capital is telling you. What is the rate of return that the company generates per dollar of assets that they employ, or per dollar of capital, I should say, that they have employed, right? So, this basically shows you the rate of return that the company generates on the total capital that it has raised from debt holders and shareholders. Measures capital efficiency and capital deployment. And this is the number that compounds over time. So when you look at a company's earnings growth, right, what you're really looking at is their compound rate of return. So this is the derivative, or the underlying number that you see revealed in a chart of their earnings per share growth. So this is what Charlie Munger, Warren Buffett, Seth Klarman, Bill Miller, Peter Lynch, all the great investors of our time. This is what they talk about: is rather than looking at earnings per share growth, you should be looking at ROIC, because this is the rate of return that they're generating to achieve that growth rate, right? So if you have a company that, is growing at 10, 15%, that sounds good. But what if it requires a lot of capital to achieve that 10% growth or 15% growth? Or stated differently, what if you have two companies, they both are growing at 10%, but one requires half the amount of capital to do it compared to the other? The one that has less capital required to achieve that same growth is the one that's going to outperform the other one, all else held equal, because they have a better rate of return. They're putting their money into projects that have a much better rate of return than the other one. And lastly, and this is something that's most important, perhaps, is that if you can find a company that has consistently high ROIC, that is a strong indicator of the presence of an economic moat. And this is what we love to do as investors. We want to make sure that the companies that we own are not going to get disrupted by other companies. So if you can find companies that have high ROIC, not only right now, but have consistently done so, over the last several years, my minimum threshold will be 5 years, right? Then that's an indication that the company's doing something that is not easily replicable by other companies, by other competitors. Or they operate in a market that's big enough for multiple players. So again, either way, that helps you build that margin of safety, so that, a company that does consistently high ROIC for, 5 years, there's a high likelihood that that trend will continue for some time, because ROIC is not something that kind of disappears, instantaneously. With a few exceptions, of course. There are companies that have had, high ROIC for a long time, and then they've fallen off track. IBM is one of them. So that, again, it's not a perfect measure, but it helps you increase your accuracy. So, and it helps you make sure that you're not falling into these value traps. So many companies that trade at low multiples do so because they have very low ROIC. An example would be Ford and GM. Those two companies trade at somewhere between 8 to 10 times earnings, which is super low, right? But if you look at their ROIC, it's basically somewhere between 1 to 3%. So that's kind of the reason why it trades at such a low multiple. So what we want to do is make sure that if we are using price to earnings multiples, we want to also make sure that we're not falling into value traps. And so we're looking for high ROIC companies, and especially ones that have consistently done high ROIC for some time. Next is revenue growth, right? And this is very simple. What does revenue growth really tell you? It tells you whether the company's products and services are in demand relative to alternatives, right? So again, another reason why so many companies trade at low multiples are because they are often businesses that are being disrupted by new technologies, stronger competition, or even poor execution by management. So again, this is another sort of layer that you can add on to your low PE multiple strategy to make sure that you're not falling into value traps. So what we're looking for are companies that not necessarily have super high revenue growth, but at least have revenue growth something greater than zero, right? You don't want to see companies that are dropping in revenue, because then you're, essentially trying to pick a low multiple stock, but also one that is going through, some challenges with their competitive positioning in the market. So that's something that you definitely want to avoid. So bringing it all together here, we've identified 4 key criteria to make sure that you're not falling into value traps, and you can help isolate true deep value opportunities. So one is revenue growth. Again, it doesn't have to be very high. Just something above zero is fine at the very minimum. We want high returns on invested capital. or in some cases, a high rate of change in the ROIC. We're going to take a look at an example of that in a second here. We're looking for deep multiple compression on a relative basis. And we want a large discount to intrinsic value based on modest EPS growth forecast. So we're going to take a look at all of these here. And so what are these, I know the webinar was labeled as 5 deep value opportunities, but I'm going to do you one better. I have 6, deep value opportunities based on these 4, key criteria that I put together. And here they are. So these are the 6 that I'm just going to talk about briefly here today. And the first one is Sprouts Farmers Market. And then you can see here as well, Best Buy, Pterodyne, AutoZone, AbbVie, and Hewlett Packard. And, we can spend an hour or more on each one of these, but I'm just going to go through some key highlights here for each one of them. And we're going to use advisor tools to help understand, how to view these types of companies. So first, let me dive into advisor tools. I'm just going to bring that up here. And I've actually set up a table that's available directly within this table builder here. And I've went ahead and already built out this equity watch list here with these 6 companies, but you can basically do that from the homepage, and you can start to enter these tickers in just by clicking on Manage Watch List or Create New Watch List. And I just entered these 6 companies in here, and I created a table that helps me just quickly visually see some of these key metrics that I just talked about on these slides here. And you can see that very quickly what the PE on a trailing 12-month basis is, on a forward basis as well, what the sales growth is over the past 5 years, earnings growth, and this ROIC here, as well as the 5-year average ROIC. Because remember, we want not just strong ROIC right now, but we want consistently strong ROIC for at least 5 years. So that's what this is telling you. So you can see here that Pterodyne, for example, this is not super deep value. Obviously, it trades at a PE of 24. But I just wanted to toss this into this presentation as well because this is a stock that's basically trading in line with the market right now at about 24, 23 times earnings, but has better revenue growth and excellent ROIC right now at 35%. 22% on average over the past 5 years. So you can see that the current period is actually much better than the 5-year average. So we see that there's a rate of change here, and that's a really good thing to see there. But check this out, though, for Best Buy. You've got a stock that's trading at 13.7 times earnings on a trailing basis, 14.8 forward. Very, very low multiple. And you can see here that for such a low multiple, it's actually got 3% revenue growth, which if you can think about this for a second, this is a retail company, a bricks and mortar retail company that, has survived the incredible onslaught of the shift to online e-commerce. So you would think that a company like Best Buy, who sells, technology products and home appliances, would have gotten decimated by the likes of Amazon and Wayfair. But you can see here that they've actually withstood that and have continued to grow through that at 3%. It's not, rock your socks off growth, but it's still, growth nonetheless. So, compare that to other bricks and mortar retail companies who have, very deeply negative revenue growth because they're getting disrupted, like Macy's, for example. So, compared to others, Best Buy has had, very, very strong sales growth, given what's happened to the retail space overall. And you can see here on the bottom line, 21% earnings growth. So this is happening on the backs of just 3.3% revenue growth, but on earnings, it's at 21%. That's just phenomenal. And we'll see, if you read the report on Best Buy, and so this is kind of where you would go to understand what the company is doing, to achieve this. But they've really shifted their model away from being reliant on hardware sales to being more of a service provider. So a greater mix of Best Buy's revenue has been coming from services such as in-home installations, or warranties, or their computer repair business. So they have this division called Geek Squad. I'm sure you've seen it if you visited Best Buy, um, where they earn their revenues based on computer repair, in-home installation, warranties, and other things like that. So these are areas that Amazon and Wayfair can't really compete on because they don't offer services like that. Best Buy does, and they've kind of built both a good hybrid between bricks and mortar and online. And if you read their report, it'll actually talk about that. So you can actually click onto Best Buy and see the report on that. So if we go into the analyst report, we'll actually see exactly that. The discussion on that as well. So this is how I would, go about, thinking these things through. Is if you have a screen that you've built that looks for low PE stocks, and you're inevitably going to get some retail companies in there, like Best Buy. And what I would do is to read the report, especially page 1, but really page 2 and 3. And what I would look for retail companies is, companies that have increasing digital sales, right? So we want to make sure that Best Buy is also participating in this overall shift to online sales. And here's point number 2, surging digital sales. There you go. So Best Buy's strategy has successfully, exploited this shift to online. And that's a great thing to see because we don't want to see companies like Best Buy go under because they were not able to keep up with the shift in online, right? So that's one thing that we definitely want to see here. And the other thing we want to see is, how are they differentiating themselves, right? Because with Amazon and Wayfair, there's so much competition that margins have really been driven down, right? So for their hardware sales, like their sales of technology and gadgets, obviously those don't come with a very high margin. So how should they operate in a low margin environment? And that's why, I mentioned earlier that, they really have differentiated themselves by offering services as a complement to their products that they sell. So that's the key driving factor behind that earnings growth that we see here. Services come with a much better margin than selling devices like, iPhones and Android devices. That comes obviously with a very low margin, but services come with a much better margin. So like if you were to buy a home theater system from them, they wouldn't make a whole lot of margin from the sale of that home theater system, but they would make a much better margin, if you chose to ask them to install it for you in your house. So that's really the key driver behind this entire story. And if you read this report, you'll get a full understanding as to how they're doing that. So again, I would make sure that if you are looking at these deep value opportunities, you want to make sure that that they're actually able to execute on not just the shift to online, but also the shift to services as well to help differentiate themselves. And actually, I did not. I guess I didn't save that table that I had before, but so it kind of reverted back to the table that that's defaulted here. But you can see each one of these here all trade at very, very low multiples. And what I'm also going to show you is that relative PE multiple compression chart. So if we go back to, let's say, Sprouts Farmers Market. Now, Sprouts is a organic grocery store, and they've had great growth, and most of it is due to same store sales growth, or sorry, most of it is due to actual growth in the number of locations, right? And we can see that if we go over to the fundamental chart, and if we look at Sprouts revenue growth, just going to uncheck some of these here, so we can just see their pure revenue growth. Check out that revenue growth there. again, for a company that trades at such a low multiple, right? We saw it trades at almost, 12 times earnings, right? You've seen, 56% growth in revenue over the past 3 years. So that's just phenomenal. If we change this to 1 year percent change, you can see that year over year the growth rate has been about 14%. That's a little bit lower than about 2 years ago at 23%, but still, for a company that trades at such a low multiple, this is exactly what you want to see. Is strong revenue growth. My minimum threshold is just something greater than zero, but this is much better than that at 14.4%. Now let's look at the multiple over time, right? We want to see not just the PE multiple as it stands today, but we want to see how it has done over time. And so I'm going to toss in the forward PE multiple here. And I'm going to uncheck the revenue growth for now so we can just see the PE multiple. And let's go back to the raw value estimate, or the raw value itself. So not the percent change, and just take a look at that here. Just from an absolute basis, the stock used to trade at a PE of 20 times, not too long ago, back in 2018. And that has, contracted all the way down to a very low of about 10 and a half. And it's back up to about 13 right now. So still very, very low on this, 3-year chart. We can go back further and just take a look at it. You can see that it's just gone straight down, straight down. Now, this is because same-store sales growth has slowed. So again, if you read our Zacks research report on it, it will kind of tell you that a little bit more. But again, you can see that if I were to change this to make it relative, right, to the sector average or even to the S&P average, you can see the PE multiple compression that it's gone through. So now you can see that number is 6.65. That's telling you that it's trading at a 35% discount relative to the sector average. And that compares to almost a 25 to 30% premium that it traded to the sector average back in 2017. So again, we have seen this incredible PE multiple contraction, right? And yeah, I guess we can say that this is going to continue. What's to say that it doesn't continue? And it might very well continue to do so. But given the revenue growth that I see here, and given the fact that it's trading at such a extraordinary low multiple, I think this is prime for a recovery here. And this is a organic grocery store. So obviously in the grocery business, it's a very competitive business. Margins are quite low. But if I look at the ROIC of this company, and I actually have created an Excel spreadsheet that helps you view the ROIC. I'm going to type in SFM in this Excel sheet here. And this is an add-on that you can get through Advisor Tools as well, called the Zacks Excel link. And you can access that through the, if you go over to support, and here is the Excel link option. This is an add-on, so you may already have subscribed to this, but if not, that is an add-on feature. And so if you would like, to get access to that, please do reach out to us at zat@zacks.com, and we can talk about what that would entail as well. So the Excel add-in here for Sprouts, I'm just going to run this here, hit refresh all. And this is my spreadsheet that does that calculation that I mentioned, EBIT relative to total capital. And EBIT, once again, is operating income. So for such a low multiple stock, one would expect this company to have a very low ROIC. But check this out, almost 17% ROIC. And it's been consistently good with the exception of 1 year right here, 9.6%. You can see that it's been exceptional over the past several years, 17 to 18, almost 19% 1 year. So again, this passes that other criteria that I mentioned. which is not only good ROIC right now, but you want to see consistently good ROIC for at least 5 years. And you can see that there. Because keep in mind, if a company does really good returns on invested capital for a year, what that's going to do is that's going to attract competition. And they're going to take a look at what they're doing and they're going to replicate it. And so if it's a sort of zero-sum game where, where like an entrenched player can simply replicate what you do and take away that advantage that you have, then, this ROIC should have dropped off. But it has not for Sprouts, right? And this is great. This is basically telling you that Sprouts is earning a very high return per dollar of capital that they're deploying, right? And again, this is a grocery store business. It is ultimately a retail business. And that means that they are investing a lot of capital in growing their number of retail locations, right? So this number is a great number to assess how efficient Sprouts is on the capital that they deploy. Why? Because they're spending a lot of money in growing their number of retail locations nationwide, right? That costs money, right? So we want to know, okay, even if they're spending a lot, let's see what return are they generating, per dollar that they employ in growing their number of retail locations. So 17% is excellent for such a low, especially for such a low multiple company, at just 13 times earnings. A 17% rate of return on its capital base is excellent. I can name you, dozens of companies that, trade at, higher multiples, but have lower ROIC, right? So this to me is, a classic example of a deep value opportunity. Companies that trade at a very low multiple and yet are still doing something that's very attractive, by the way. This is not some dying industry, right? It's not a company that is operating in some dinosaur, industry. It's an organic grocery store. And, with people switching towards healthier options, and with prices coming down too, organic, groceries were a lot more expensive, 5 to 10 years ago. And now, they're getting more affordable, as competition increases and as scale, kicks in, economies of scale, prices have come down and, more people are opting to shop at organic grocery stores or at least getting some of their groceries from an organic store. So, this looks to me like an extremely attractive, investment opportunity. Company that, people like, it's a pleasant experience to go to a Sprouts, store. So again, all of this being put together here, both using numbers and some just general, basic, common sense would tell you that, this is a company that, one would actually like to be a part of, right? They're kind of a part of the solution rather than a part of the problem, if you will. So it's a feel good company and it's a company that produces, really attractive numbers and it trades at a very, very attractive multiple, right here, as you can see here. So these are all, examples. If you go through each one of these companies, they kind of have the same, the very same, fundamental numbers here. Let's take a look at Pterodyne, right? Pterodyne is a little bit of a different situation. They don't trade at such a low multiple, right? But you can see that they trade sideways here in their multiple. So you can see here that the on a relative basis, right? And so we have this chart that we already set up here. Originally, we're comparing the company to its sector average, and you can see here that it's kind of sideways for some time, but it does trade at a discount. You can see here that the current ratio of Teradyne's forward PE relative to the global sector average, which is technology companies, it's trading at 0.77. So it is trading at a 23% discount to the tech sector average. And it has growth that's similar to the tech sector average. So if I were to type in the revenue per share here and start to look at that, look at the growth in revenue here for Teradyne. And if I were to change this to 1 year, performance, 1 year percent change, look at that growth rate, 16%, right? So again, or sorry, 36%, I should say. So that's even better than, much better than, Sprouts. It does trade at a premium to Sprouts, right? Um, but you can see that, this growth rate is just phenomenal. So for a company that trades at a discount to the sector average here, it's got some really good, revenue growth. So that's excellent to see. How are they doing this, right? So again, I would refer to the research report to understand a little bit more about what they do, right? So our Zacks research report will tell us, um, and actually let me go to the actual research report here. Um, so if I type in TER and go back to this key stats page here and just click on the analyst report. So what does Pterodyne do? Just briefly, they make modules that are used by the semiconductor industry so that they can do all of their performance benchmarking. So all of the chip companies out there, like Intel, AMD, NVIDIA, um, and others, they once they build their chips, they need modules to help them benchmark their chips to ensure that they are performing at the levels that they're targeting. So it's essentially kind of like like you're running a diagnostic. Once you've built the chip, you just want to make sure through your quality control and QCing efforts, you want to make sure that the chip is performing up to par. And so Teradyne makes those modules that essentially does that performance testing for those chips. So this is intrinsically related to the semiconductor industry. However, what they also do, which is really cool, is that they make robotic arms and autonomous robots. So they're actually positioned in sort of the next generation of of manufacturing. You can see that there. Some of this, in these in the description here, you can see exactly what they do. So you can see that the company is primarily focused on the semiconductor test market, which generates the bulk of its revenues. It also provides specialized system testing equipment for specific end markets. Um, and so you can see exactly what they do there. So again, this is a company that really is positioned in the next wave of growth, right? And yet it trades at a very reasonable multiple. It's only 23 times earnings. Now, again, that's not super cheap, so I wouldn't call it deep value. But I will say that the reason why I bring it up is because you can find companies that trade at a very reasonable multiple right now, and not have to overpay for it, and not have to pay extraordinary multiples that you see in other parts of the technology sector. So what do they do? Or like, what do they do in terms of ROIC? Let's take a look at that. And this is where I think the key value driver is, for Teradyne. Or to type in Teradyne, hit refresh all here, so that the numbers will then, automatically update. And this is where there is a huge, upside for Teradyne. Look at what's happening to their ROIC, 35%. And on top of that, the growth rate of that ROIC is even better. Last year they did 25%. The year before that, 19%. Several years before that, in the low single digits. So you can see this terrific growth in not just revenue, right, but also increasing efficiency at the same time. So that's basically giving you a compound effect. You have not just revenue growth, but you have increasing ROIC, right? So that's kind of the driver behind the stock, and for it to trade at only 24 times earnings, which is basically the S&P average right now. It's slightly above the S&P average, but you can see that you're getting a lot more bang for your buck. You're getting solid revenue growth. You're getting even better ROIC, and you're getting even better ROIC growth. So that's exactly what I love to see. Companies that trade at reasonable multiples, but have very strong value creation. And so this is a strong piece of evidence that tells you that what Teradyne is doing is is not very easily replicable. If Nvidia or if Intel or AMD could do this themselves, they would have already done it, and they haven't, right? So Teradyne clearly has an advantage here. It does not make sense for other companies to do this because Teradyne is just so amazingly efficient at what they do. And you can see that evidence here with this ROIC. So again, companies that have consistently good ROIC tend to have that continue on for some time. So again, phenomenal opportunities in the market right now. Let's take a look at another one. This is one of my personal favorites, and a disclosure before I start talking about this one is I do have a personal position in AbbVie. So I just wanted to clear that, before I, continued on with that. AbbVie is another amazing opportunity in my view, because again, take a look at what is going on with their valuation. We're to toss in AbbVie here and just look at their price earnings multiple. Just gonna type that into here, financial metrics, search for PE, and here is that PE F12M. Look at that multiple. Contracted by 44% over the past 3 years. Let's look at what it is on a raw basis. Check this out, 8.5 times earnings, right? 8.5 times earnings. This is a stock that trades at such a low multiple. How does it trade relative to the sector average? Let's take a look. Because this could be a phenomenon where, drug companies overall are going through, multiple contractions. So let's see, does it, is it in line with the market overall, or is it something specific to AbbVie? And check that out. You can see that is absolutely something specific to AbbVie. It's not only compressed over time relative to the sector average, and it also trades at a substantial discount, at 0.39. That's the ratio of AbbVie's PE to the healthcare sector average is, 0.39. So that means it trades at a 61% discount to healthcare stocks overall. For a company that trades this low, one would think that there's some bankruptcy risk or there's some, major disruption that they're, going through, that someone is, about to put them out, right? Well, let's look at their revenue growth. Look at that. You can see revenues per share have grown. In fact, if I change the performance here, look at that. It's been up 45%, 46% over the past 3 years. So that's, again, that this does not look like a company that's about to go under to me. If I change this to 1 year, year-over-year growth in revenue, again, 15%. So for a stock that trades at 8.5 times earnings, this is a company that's grown revenue by 15%, year over year. And this is actually relative to healthcare, I should say, relative to the healthcare sector average. So you can see that they've actually beat the healthcare sector average in terms of revenue growth. So it trades at a discount, and yet it has grown better than healthcare stocks overall. That to me is a phenomenal opportunity, to take a position right now, in my view. Again, full disclosure, I own it myself, so I'm kind of talking my book here, but it's hard for me to see a bear case on this. However, if you do look at the research report, there is a fundamental reason why AbbVie has gotten so cheap. And if you read the report, it'll actually tell you about that, and that's mainly because their key drug Humira. Humira is their number one revenue grossing drug, and what's happening to that is that there is competition that's about to enter in 2023, and so there's a number of bioequivalent drugs that are about to hit the market that will probably take a lot of share away from Humira. And so since Humira is their number one drug, there is a fear in the market that their biggest revenue driver is about to get disrupted. And that is true, right? I'm not going to dispute that. However, if you look at their drug pipeline, okay, if you look at their drug pipeline, you can actually look at some of what they're doing here. Humira, this is talking about Humira, but other key drugs are also discussed in here. And if you see what the forecasts are for the remaining drug portfolio, as well as the pipeline that they have coming online over the next decade, what you will find is that the other drugs in their pipeline, as well as the Allergan acquisition, you see that described here, will diversify their portfolio enough to fully replace the revenues lost from Humira. Okay, and so you can see that they've also done a number of collaborations and agreements to strengthen their pipeline again. So AbbVie knows this clearly. Management knows that Humira is, their time is limited. So they have made a number of moves strategically to make sure that the company does not suffer when that actually happens. So right now, however, Humira sales are going strong. So again, they're generating a lot of cash flow from Humira right now and reinvesting that back into their pipeline so that they reduce their dependence on Humira, right? And so this entire report kind of talks about that. You can also see that they've been growing their oncology portfolio. Again, AbbVie is one of the global leaders of not just not just their where Humira competes in, which is in that space, but also they're a global leader in oncology, and that's a phenomenal area to be, obviously. And that portfolio has been growing, right? You can see that discussed here. So what does it look like, right? What does their ROIC look like? So again, if I were to type in AbbVie into the spreadsheet here and hit refresh all, you can see again and keeping this into context, AbbVie trades at 8.5 times earnings, so it's a very, very deeply discounted stock, both on an absolute basis and on a relative basis. And let's check this out here. You can see that ROIC is about 10%. So that's lower than what we've seen in other places. But they have done, better ROIC in the past. However, if you see over to the right here, this is a key thing that's specific to AbbVie, where what I've done in the spreadsheet is lagged the denominator by 1.5 years. And look at the ROIC in that scenario. And check that out. That number is much better at 25%. So what this is telling you is that, when AbbVie invests capital into its own pipeline, it typically takes about 1.5 years or so for you to start seeing the results of that. Right? And that makes sense, right? When you make an investment today, you don't necessarily see the fruits of that investment immediately, right? So ROIC looks at that immediately. What are investments today versus what's your operating income today? Whereas on this chart, it helps delay that, so you can see that what were the investments made 1.5 years ago relative to your operating income today. And so that number looks really good at almost 25%, and it's been consistent. With the brief exception of 2018, it's been pretty consistent here over the last 5 to 6 years here. So again, this is something that you definitely want to see happen. And if you scroll down, you can see that there's another number that I've also included, which is adjusted EBIT to invested capital with that 1.5-year lag. And this is basically just adding back R&D, right? So for a company like AbbVie, the main expense that they have is R&D, right? Obviously, that's their bread and butter. That's obviously where all of their investment dollars are going into, right, to develop their drug portfolio. So if you were to treat that as an investment rather than as an expense, then you can see what the ROIC looks like in that scenario at 34%. So underlying all of this is very strong capital efficiency for AbbVie. So every company is different, right? Some companies, they don't need a lot of time to realize the fruits of their labor. Other companies do, and so it's a case by case basis. And so that's why I would look at all of these charts here, and as long as one of them is indicating very strong ROIC, um, or at least one of them is indicating increasing ROIC, then that's going to tell you that there is underlying value creation, and therefore the fact that they're so cheap is actually a bargain and not a value trap. Okay, so this is the type of analysis that I would be doing for each one of these companies here, and I have not talked about. Let's go to the other one, AutoZone. Yeah, AutoZone is another one. Let's type in AutoZone here, and this is again another company that is in the retail space, but it trades at a very, very low multiple again. What type of multiple? Let's look at that first before we look at the ROIC. So again, let's go back to the fundamental chart, and I'm going to type in AutoZone, and we'll just uncheck AbbVie here. We're going to toss on the PE as well. I really should save these. I don't have it saved here, so that's why it keeps reverting back. But if you have it saved here, then you don't have to always re-add it the way that I'm doing right now. But let's look at the the price and earnings multiple for AutoZone. We'll switch it back to the raw value, and you can see that AutoZone trades at 15 times earnings. You can see that there, 15 times earnings. If we switch that to the relative sector average here, relative ratio, you can see the multiple compression that's really gone through, especially during the COVID crisis. Check that out here. It used to be at almost parity to the sector average here, and the sector is consumer discretionary stocks. Since then, it's been cut in half, going from a relative PE of roughly 1 to a relative PE all the way down to 0.4 at the lows and 0.54 today. So very, very low multiples on both an absolute basis and on a relative basis. You can see that relative contraction here. But let's take a look at what their revenue growth is. What's been their revenue growth, and check that out. They've actually grown their revenues even through the COVID shutdown. And you'll see that they've done this because again, they have positioned themselves well with online sales. So that's the key. Whenever you're looking at retail stocks, I would absolutely be reading the research report that we have and make sure what are they doing to combat the shift to online. And so if you read the report, I'm not going to get into it too much here as we're getting close to our cutoff time. Don't want to run too much over our time slot. But again, they've been successfully implementing the shift to online. You can see the results of that. Very consistent revenue growth. So for a stock that just got cut in half in terms of its relative PE multiple, I don't see anything fundamentally wrong with the company going on right now. They've continued to grow even through the COVID shutdown. And over the past 5 years, check out that revenue growth here. Very consistent revenue growth. So this is excellent. I mean, you would not expect a company that has such, consistent revenue growth. And by the way, in an industry that has been around for a long time. In fact, this is actually a member of our earning certain portfolio. So if you are familiar with our, best, selling and best performing earning certain portfolio, this is actually a member of that. And so for a company that has had such consistent earnings growth, consistent revenue growth, and yet it trades at such a low multiple at the same time, one would think that the only missing link would be that they have a very low return on invested capital, right? Because if everything else is happening, but if ROIC is very, very low, that may help justify a low multiple and therefore low returns. But let's look at their ROIC. Check that out, 34% ROIC. Now that is trending lower here. You can see that clearly. But again, it's trending lower from an exceptionally high ROIC at one point. So that's not a bad thing at all. And if you look at it on the 1.5 year lag, you can see that it's actually not declining as fast. So what this is telling me is that, as, AutoZone invests in new locations, they have actually accelerated their investments, and that's why you're seeing this drop in the ROIC. But if you lag it by a year and a half, you can see that it's been consistent and consistently high at that, at 45.8% on a 1.5 year lag. So again, just like Sprouts, just like Best Buy, as AutoZone invests in new locations, that's all capital that they're deploying, right? We want to make sure that given all of that capital that they're spending on growing their retail presence, as well as growing their online presence too, right? Because that does require a lot of investments as well. We want to make sure that they're earning a return that's attractive on all of that spending. And this is basically telling you that that's absolutely happening with AutoZone. So again, this is all, all these pieces kind of, fit together and say, if you have strong revenue growth, if you have very low multiples, if you have multiple compression, and if you have very high ROIC, that is, the sort of the framework or the groundwork for identifying a very, very attractively priced company. So again, I would read the research report on AutoZone to see exactly what they're doing, but that's what I've found that they have successfully done is position themselves to benefit from the shift to online, and that's really what they've done in a really, really effective way. And you can see that by their returns on invested capital. And again, this is one of the reasons why the earnings certain portfolio has done so well, is because the vast majority of the companies that are in that not only have consistent earnings growth, but you see that they also have very strong returns on invested capital. So again, these are companies that are generating very, very strong economic profits, really. Profits that are in excess of what investors would require, if you go back to the classic theory of the weighted average cost of capital. Not to get into that subject too much, but again, these are companies that are cheap for reasons that I think are transitory, and I think will provide very strong returns, even if we see increasing interest rates going forward, because they trade at such low multiples that the potential returns are very, very attractive. I'm going to tell you one last thing here before I leave it here. And the last company that I'll just quickly mention is Hewlett Packard. Hewlett Packard trades at an exceptionally low multiple, right? Hewlett Packard, just going to type that in here. And we can see that this trades at a exceptionally low, PE, multiple here. If I were to type in the PE ratio here, check that out. Again, 9 times earnings, right? Very, very low. So what's been their ROIC, right? HPQ, hit refresh all. And so again, one would expect that for a company that's so low in their valuation, they should be doing very low ROIC, right? But check this out, 42.6%, incredible. And that too, we see growth in that number too on the gross profit level, and increasing it on the adjusted EBIT versus the 1.5-year lag. So again, this is exactly the type of thing you want to see. Either we want to see consistently high and flat, or increasing. Either one is something that we want to see. And that's really something, that's really occurred, especially as of 2016. So for a company that trades at such low multiples, I think Hewlett Packard is a great buy at this point in time, because they are such efficient capital compounders. Now, Hewlett Packard is a cyclical company, meaning their earnings does wax and wane a little bit from time to time. But you can see that really since 2016, they've kind of reinvented themselves, and you've seen that revenue stabilize and now increase, through this entire time period. And to understand why, you definitely want to read our research report on that. But all of these 5 companies that I have mentioned here, I think are primed for very attractive returns, especially as companies in other sectors, especially technology, reach, stratospheric valuations. I think there will be some bargain hunting that will go on. There will be some, not a lot, but some rotation towards deep value stocks like these, who have gotten beaten down so much on their relative multiples that I think they will be primed for a run in the next couple over the next couple of years here. So with that, I'm going to end it there. I'll just take a few questions here. The first question is, how do you measure intangible assets, which seem to be more important today than tangible assets? So yeah, intangible assets are a part of the ROIC calculation. You'll see that in the table right here. So you absolutely do want to make sure that intangibles are included, such as goodwill, because that includes acquisitions that the company has made. So if a company went out and made an acquisition, again, that should be treated as total capital. So you want to judge the company's operating income relative to all that money that they spent on any acquisitions that they made. So that, great question. So that's something that you do want to include there. Another question, is a recording going to be available? Yes, absolutely. And a recording will be available. We will upload that to our YouTube channel. And lastly, the question about Zacks' rank on Best Buy is a sell at number 4. Yes, that's true. The Zacks rank currently is a sell on Best Buy. However, the Zacks rank is a little bit more transitory, meaning it can vary a little bit from time to time based on just sort of the shorter term overall picture. And the Zacks rank is not really meant to be a long-term investment recommendation, but more so a short-term model. So if, say, for example, analysts cut their estimate for this year by, let's say, a couple of percentage points, as you see here for Best Buy, this is the reason why it is a sell right now, because you do see that analysts have revised their estimate down by about 5.8% or so. But that's not necessarily a bad thing. It's just looking at it relative to all other companies out there. So, a company could have just, a minus 1% estimate revision down. But if companies on the aggregate have a plus 1%, then that's going to play unfavorably into the Zacks indicator rank. And say, for example, if Best Buy had, 20% earnings growth, right, over the past year, and then analysts have also revised their estimates up over that entire time period, and then let's just say they cut it by 5%. So that even though it's a cut, overall their revenue growth or earnings growth has still been phenomenal, right? So that's exactly what you want to see, in that. I hope everyone found this webinar useful. Again, if you have any questions, please do reach out at zat@zacks.com. Again, zat@zacks.com. Once again, my name is Mayur Thaker, and I will be hosting many more of these types of webinars in the future. And if you do have any other questions, please do direct them directly to zat@zacks.com. All right, everyone, have a good weekend and stay safe, and talk to you soon. All right, take care. Bye-bye.